Do you agree with Jane Fraser that you're not worried about a recession? She doesn't seem to be.
Yeah, I would agree with that. There's a few kind of interesting comments, and as she noted, a robust consumer. In an environment where some of us are worried about the labor market, the robust consumer, strong growth. The Atlanta Fed is actually tracking 3% for GDP growth in Q3. There's a lot of mixed signals on that front. I would watch items like the labor market and the jobless claims data that we see. The loan churn environment that she was talking about in the labor market is absolutely there. And the thing you get worried about is if layoffs begin to pick up, then undermines the consumer, and then we can have recessionary dynamics. I would caution about interpreting this morning's data point as that. There's a weird spike in the Texas jobless claims, which seems to be associated with the floods that you had earlier in July. So I don't think that that was actually a real print. I would expect that that comes back down.
I have to be honest, I'm really confused about the inflation side of this economic story right now and why we're not seeing tariff price increases pass through on the data. And I can share an anecdote yesterday. Looking at an e-bike battery, for example, went to a shop, an $800 battery that a few months ago was $800 is now $1,100 as a result of tariffs. We're not seeing that 20% increase in the data yet. Why not?
So I think we are actually seeing it. If you were to decompose the consumer price basket between those items that have high import content, those that have low import content, we are seeing a big acceleration in inflation in the high import content items. In past months, we saw household furnishings rise, recreational goods rise. We've now begun to see that in motor vehicle parts,
trucks,
motor vehicle
right?
repair. Yeah. Apparel inflation actually rose pretty robustly this month. So it's been a mixed picture. Used cars and trucks, new vehicles have not shown it. In prior months, you had seen some offset from airfares and from services items, but we are seeing it. What has not happened, I think, is the scary large inflation prints that we were all worried about. But inflation's at 3%, and it's been well above the Fed's target for the past 4.5 years. And most of the recent increase is being driven by tariffs.
So you, in your notes that you shared with us, say that there's still scope for the first round of tariffs to have a further impact on inflation in the near term. What kind of impact, Matt?
So I think that comes from our view on PPI data. So earlier this week, yesterday, we got the PPI. And again, that was actually weaker than anticipated when you looked at the headlines and the core. But when you look at the underlying details, there's a lot of pipeline inflation that's coming through with that. And so I would expect that you actually continue to see an acceleration in core goods inflation through the end of this year. Now, for the Fed, and as we look forward to monetary policy next week, a lot of Fed officials have taken the view, look, we're going to look through a lot of this tariff-driven inflation. And as long as it is isolated to items like core goods that we think that it's tariffs, we can still cut rates. And of course, for the Fed, they're a dual mandate central bank. So it's not just the inflation picture. What's happening in the labor market matters a lot there. And so the fact that we got a weak jobs report last Friday, big downward revisions earlier this week, leans them in a dovish direction in the near term.
What I don't understand is, though, if we are in a higher tariff rate environment that's going to exist going forward, why is it we can look forward to it? Because it does mean higher prices, right? And either companies have to eat it or we have to eat it.
So it does, but the theory is that it's
and
really
doesn't that mean inflation ticks higher?
In the near term, yes. But if it's a one-time price increase, it should not be a sustained inflation shock.
Oh, I see what you're saying.
You know, there's a word for that.
Numerically.
There's a word for that.
The word is transitory.
Okay,
I'm not going to. I'm not
just making sure we're
after going through having a forecast in 2020 and 2021. Okay. I'm trying to avoid the transitory language, but yes.
Yeah.
The idea is that it is a one-time price shock. Now it's going to take a while to play out, and I think from the PPI data we see this is going to last into 2026. And so even if it is one time or quote unquote transitory, it takes a while to play out.
Hey, on the labor market, going back to fundamental shifts that we've seen in the last few months during this administration, and Carol's mention of that weak jobs report, do we need to think about labor completely differently with immigration shut down in this country?
Yes. And absolutely how we think about those monthly jobs prints has changed dramatically over the past 2 years. I think if you go back 2 years ago when we were having the surge in immigration, 200,000 plus was the norm for payroll gains. Now, some of those have been revised down. But in this current environment, given demographics, given immigration flows, 50,000 is probably a perfectly fine number to keep the unemployment rate steady. And so I think we should revamp how we think about things. But the uncertainty around that suggests that we should focus on other things. The unemployment rate matters more than payroll gains matter. Things like the quits rate, job openings to unemployed, these measures of labor market slack are the most important indicators for our assessment of the labor market. And although they haven't weakened a lot, they've started to show some early signs of modest weakening.